So it is Fridays in Fintech, and we have an amazing guest today, Mike Silver. Mike, it's great to have you here.
Great to be here.
Yeah, so a little bit about Mike, super impressive background. Love him, hate him. No, I love him. But he started his career out doing at the FTC, and then also was a judicial intern for the Honorable Ricardo Urbina. And then really started his career as a senior associate at Pillsbury, Winthrop, Shaw, and Pittman, where he drafted and negotiated hundreds of leases, purchases, sale agreements, and other complex real estate financing contracts. And from there, he spent over a decade at really leading things at the CFPB. He was senior counsel at the Office of Regulations for the CFPB. One of the cool things he did, you guys may have heard of it, led the rulemaking for the CFPB's 2024 non-sufficient funds proposal. And now he's a partner at Husch Blackwell. Is that correct?
That's right.
Yeah. So, Mike, it's great to have you here. And really, on our shows, we like to ask the tough questions. And that tough question is, do you prefer pineapple on your pizza?
So I'm ready for this tough question. It makes me think of Inside Out. I know there's a sequel coming out for the Pixar movie. The original one where Louis Black's anger said, congratulations, San Francisco, you've ruined pizza. That was talking about broccoli, but this one's talking about pineapple. I'm like kind of a fan. I'm more of a meatball on the pizza guy.
Oh, nice.
I grew up in New Jersey, so I'm pretty spoiled as far as
Oh,
quality.
yeah. I'm in San Francisco, and it's good, but man, New York, New Jersey, like the pizza is just, it's out of this world. It's so good. Do you have any good spots?
Well, actually, growing up, my next door neighbor, the family was from Italy, and the father owned the local pizza shop. So we used to go there all the time, especially at high school, when we could actually leave the high school during senior year
Oh man,
for lunch.
that's cool. The local spots. That's where you do it. That's where you
There's
do
a
it.
million of them in northern New Jersey.
Yeah, yeah. That's that's interesting. So really, kind of, I wanted to touch. You spent really time starting out, getting a lot of your legal experience doing real estate, and then you went to the CFPB. So what really sparked that? Like, hey, I'm gonna go work here and go into this. Yeah, would you mind sharing that journey?
Absolutely. I think for me, it really started during college. I was always interested in public policy and government history, and I was a history major. And I did an internship on Capitol Hill when I was a sophomore in college for my local senator, Frank Lautenberg of New Jersey. And what the assignment they gave me was to look at airline delays, and they were developing legislation that was
Airline
going
delays.
yeah, still
No
obviously
way.
this was
It's like I'm very curious now.
this was 20. Obviously, I didn't solve the problem because this was 25 years ago, and so it was basically going to develop an airline passenger bill of rights and sort of a checklist of things that passengers could be entitled to. So that really kind of sparked it. I also was the president of my student government at Penn, and we had some initiatives related to local landlords, and even some of them were owned by the university, which is a little controversial. And we did a tenant survey, and then we put out a guide to try to rate the landlords. So I think like those two experiences kind of got me going with consumer protection issues. And then, yeah, you mentioned the FTC, where I worked during law school in their consumer protection division. And then when I was in law school, I got on the track, which a lot of people do, to go to a sort of corporate type law job. And I ended up falling into commercial real estate, and it was, a good learning experience. Had one client in particular that like it was the law firm equivalent of a unicorn, which I know is a big deal in your space, where just, the person I worked with knew a guy, and he worked with another guy, and he bought some gas stations, and then we helped him buy a bunch of gas stations, and the thing blew up, and it created all this work. And I took stock of it at some point and said, did I really come to DC as a 22-year-old to help my client buy and sell gas stations? Like, cool business for him, great success story, but wasn't really why I came here. So that was the point when I I started to think about, next steps. And that happened to be 2009 when we were living through the Great Recession. And
Mm.
so people at my firm were laid off and, obviously affected the commercial real estate market a tremendous amount. And it was really just luck and opportunity meeting that the CFPB was created when I was at that
Yeah.
early inflection point in my career.
Yeah, so it was right. What year was the CFPB created? It was like 2000.
So 2010 was when Congress passed
Yeah.
the Dodd-Frank Act, and then one
Yep.
year after was when it opened.
Yep. Yep. That's exactly. So you kind of saw it's like, oh, this is pretty interesting. A new regulation. That's amazing. I'm curious. That led you to there, but really, how's it evolved over the past 15 years, almost 15 years, from like when it first? It seems like there's a lot of stuff happening recently. It's very exciting, but curious to hear your thoughts on that.
It's evolved a tremendous amount. I mean, the early years were really a sort of a serious comedy show. Like if that's an oxymoron, that makes sense. I mean, it was this. I've never worked in a startup, the type of business that you have, Jake. But from everything I've heard and people I've spoken to, it was basically the equivalent of a startup within the federal government.
Oh
And so
wow.
those first few years were really exciting, really
Hmm.
energizing, really bizarre in a lot of ways. We were inventing things on the fly, inventing processes, coming to novel legal issues for the first time. And so that part of it was really fun and engaging. But there were just some really quirky things about it. It was a very mission driven environment, particularly in the early years. There was literally someone, a research economist, who at the Christmas
Hmm.
skit show, like dressed up in full method acting of Elizabeth Warren with like the red coat and everything,
Oh my gosh.
and there was stuff like that. There was one time when um, an attorney who was interviewing someone to come into our office, they got stuck in the conference room because it was this retrofitted old brutalist like 1970s building where they put like plexiglass in these thin walls to retrofit it, and they couldn't get out. So the maintenance people started to kick down the door, which is like the obvious way, and it almost brought down all the walls and all the doors. So
Mm.
they had to come up with a new strategy to basically like do a very MacGyver kind of do the thing with the key, and then eventually they got
Hmm.
them out. And there were just a lot of um, weird but funny things that would happen in those early days, and it was very much like um, and people said this, build the
Hmm.
plane while you're flying it, or fly the plane while
Yep.
you're
Yep.
building it.
You're pretty much like we're putting together the landing gear when you're coming down. And like right, like you're in a plane, you're falling out of the sky, you're building it, and it's like, all right, that's kind
And
of
so, I
nuts.
mean, it's obviously, since then, this was like 2011 to 2013, 2014. And the
Mm.
first few years in where I worked in the regulations office, we were so focused on the mortgage market. And that was the first wave of rulemakings that we worked on. Congress mandated a lot of them. Really, after 2013, 2014, it dispersed and the Bureau got a lot more active in other markets. So I spent
Mm.
5 years working on the payday lending, card
Yep.
title, rulemaking. There were all sorts of other things that happened. And, over time, it got more settled, bureaucratized, larger,
Hmm.
but in some ways not. And I actually just today I had a thought piece that was put up in the American Banker, describing some sort of reflections on the 12 plus years at the agency, and my thesis is basically that like my daughter who just turned 12 last week, the agency is smart and growing nicely and wonderful, but is not quite mature, and it needs to mature for it to really be, I think, a successful entity. And it's amazing for them that they won, and frankly, I think for everybody, including industry, that the Supreme Court case went the way that it did. It creates a settled expectation that the CFPB is here to stay. I do
Mm.
think that now that that threat existentially is removed, they need to focus again, as they did in the early years, on institution building. And I think that that's
Yeah.
atrophied a bit, and it's
Hmm.
become in some ways more politicized over the years, unfortunately,
Yeah.
as each successive leadership has come in. But
Mm.
yeah, it was a fascinating place to work, to sort of help grow it from the ground up, and I treasured the experience.
Yeah, that's it's super fascinating, right? It's like a startup where you come in, hey, we have this new organization, and now it's still like it's grown to have its own reputation. Like it's I think almost like, well, we really need to be careful, right? Like the CFPB is also giving out, enforcement actions against institutions and how they really run operations. It's something that people really need to think about. One thing, real quick though, with the microphone, would you mind like maybe switching back to your AirPods? Uh,
Oh, are you
just
mean
so, yeah, yeah, just turn it up a little bit. I can't turn it up on my side. Um, let's see if it's any better. But
how,
it is kind of nuts, right? Like, let's see.
is this better?
It's a little bit, yeah, a little better. For some reason, it's a little quieter than normal, but it works. So it's better. It's better for sure.
I'm here to
Um,
talk about technology, and I can't get my technology to work. So,
I know it's like, yeah, we're building really cool tech, and it's like,
all right,
like, can we make
how
a
about
video call?
is it better
Okay.
now?
Yeah,
Better
yeah,
now?
that's good. That's good.
Okay,
That's good.
cool.
Um, yeah, it's kind of funny, right? Going from the CFPB starting out to where they are now. It's super fascinating. And then you talked about the Supreme Court ruling. I'd love to kind of, just for the audience, go a little deeper into that and what that means and really what was the premise of the case.
So I'm like a Generation X stereotype.
Yeah.
Uh, I was born in 1978, so I make all these references to like 80s, 90s movies. So the hopefully it's still good for your audience. The day of that case, I imagined the end of the Breakfast Club where Judd Nelson is walking across the football field, and like that iconic shot where he
Yeah.
has the fist pump, while
Yeah. That's a
Simple Minds.
classic. I know that. I'm like
All right,
I'm millennial, but I know that scene. Yeah.
crosses generations.
Yeah, yeah,
That's
yeah.
good. But literally, like that was actually kind of a meme, like inside at least our office. Whenever something really really good and significant would happen, we'd be sending that gif around of like the Judd Nelson fist pump, and so
Yeah.
that was happening. And I think deservedly so. So just to step back, basically the CFPB was created, as a reaction to the financial crisis in the late 2000s, and the premise was that at that time there were a bunch of different agencies like the Federal Reserve and the FDIC that had dispersed authority over consumer protection, and that
Mm.
again the premise was that because it was dispersed across the federal government and it wasn't centralized, basically the regulators were asleep at the wheel. And so they consolidated, and Congress passed the Dodd-Frank Act, they consolidated all of those literally 17, 18 different laws and regulations that had been spread across a number of different agencies into one agency. And they also gave the agency some new authorities, like to go after what they call abusive practices. So the CFPB, since the very beginning, has been controversial from a structural and political point of view. A lot of the critics of the agency have criticized, for example, the fact that the CFPB does not have a commission, whereas the
Mm.
Federal Trade Commission, by definition, has 5 sitting commissioners who are
Mm-hmm.
bipartisan, and
Mm-hmm.
the same is true of the board of the FDIC. The CFPB also gets its funding not from Congress through the normal appropriations process, but rather from a sort of funky structure that Congress set up to basically insulate them from having to go through congressional appropriations, which the theory was that
Interesting.
that would, kind of insulate them from political pressures. So it's that last issue, the appropriations, that was the the purpose of this latest Supreme Court challenge. There was a prior Supreme Court
Mm.
case in 2020 called Celia Law, which related to whether the president can fire the CFPB director for cause or for any reason. And because
Mm.
that was another structural piece that critics felt made the CFPB director like too powerful, too unaccountable, and things like that. The Supreme Court in 2020 found for the challengers, and so now the CFPB director is essentially answerable to the president and will change whenever there's a change in presidency.
Mm.
So the case that just was decided, it actually goes back to the payday lending rule that I don't know if we talked about earlier on the podcast, but
We briefly touched it, but yeah, I'd love to kind of dive into that. Yeah.
So for about 5 years, I was on the team, the rulemaking team that tried to draft and formulate and implement a comprehensive rule that would address payday lending, car title, and certain installment loans, high cost, small dollar loans. And so the original rule was a very comprehensive rule. It would have required mandatory underwriting requirements for these loans, somewhat modeled after the Credit Card Act, underwriting standards for credit cards. And it also had a smaller piece that essentially prevents repeat collection attempts. So if someone has an ACH, the lender takes a security interest in repayment through having ACH, they can't ping their account more than twice without getting another authorization, because there was a lot of research showing that the borrowers didn't have enough money in their account and they were getting hit with these pings, and they were then having to pay overdraft and NSF fees to their bank. So when the Trump administration leadership came in 2018, they decided to go in a different direction. So they revoked, and this is like so convoluted even for me to explain it, having
this is so fascinating to me. I'm like, how does this, because I see these fines, I know what people have to worry about. I'm building like RegTech, I'm building AI software for this, but like to see how it's done, how it's created, it's very fascinating. I love it.
Yeah,
you
like
always the politics too.
Yeah. Right, exactly. I mean, you always hear about how the sausage is made. I mean, this was like a really messy, smelly, piece of sausage, or whatever your right metaphor is. Again, we started working on it in 2012. We proposed the rule in 2016. The rule was finalized in 2017. Then the new administration goes in a different direction. They finalized a new rule in 2020 that removed that ability to pay piece, but kept the paying piece. Okay. The trade associations for the payday lenders, they didn't like any of it, so they sued to stop the rule. The lawsuit relating to the smaller piece, the payday payment provisions piece, that's what ultimately went to the Supreme Court, because in the process of that litigation over the payday rule, the payday lender groups kind of hit pay dirt, in this, no pun intended, in the sense that the Fifth Circuit Court of Appeals in Texas, they found that the CFPB did everything right as far as the rule, except they said that they violated the Constitution because their funding from the Federal Reserve violated the appropriations clause. So they basically said everything is invalid. Anything the agency does is invalid.
The way the money, the way they were funded, the way.
Correct.
Really?
Correct.
Really?
Yes.
Wow.
And this was potentially very unsettling. Wow. And even some of the industry stakeholders, like the Mortgage Bankers Association, they wrote briefs to the Supreme Court saying, guys, like, not guys and gals, like, you can't actually uphold this decision, because this would like crash the mortgage market, because now all of the CFPB's rules would potentially be
not valid, or
be unwound. Yes.
Yeah, exactly. So anything that they've said, and I can't believe, wow, I didn't really, the implications of kind of the Supreme Court ruling, what it meant, like that would have been huge. That would have been like, wow. That's crazy.
So I don't think people, like the observers who kind of follow the in this space, I don't think people were surprised that the Supreme Court sided with the CFPB. I think people were a little surprised that it was 7-2, and that Justice Thomas, who's known as probably the most conservative justice, that he wrote the opinion. So it was a pretty big validation of the CFPB on that issue.
So for people who aren't legal experts like myself, I am good with AI and compliance and consumer protection. What usually goes into an opinion, and what was that opinion about, and what does that exactly mean for like a vote?
No, I mean, it's a great question. So, there's 9 justices on the Supreme Court. So, you need a majority to, either uphold or reverse the lower court's decision. Basically, there's like a stack.
I see.
It first went to a federal district court, a trial judge. He went with the CFPB's view of the issue. It then went to an appeals court. They sided with the payday groups, and then it got appealed to the Supreme Court, and they reversed the Fifth Circuit appeals court. So 7-2 meant, there were 7 of the 9 justices who sided with the majority opinion, which,
Hmm.
mainly focused on like what the word appropriate, I'm not kidding, like what the word appropriations meant in 1789 and in pre-colonial England, like because
Well,
that's like the judicial philosophy of Clarence Thomas and some of the other, more conservative justices who signed off the opinion. So there was like an interesting kind of, and sometimes what will happen is there's a dissenting opinion, or there's an
mm,
opinion that agrees with the result but has different reasoning, and that also happened.
super fascinating. That's not. It's I love hearing it. Um, and really kind of the CFPB, that decision happened. Like, how do you see the CFPB evolving with new technologies, with kind of even new sentiment across the market? Like, what is the future of that, and how will they work with institutions, and how will institutions view them?
So this is also this relates to your earlier question a lot about how the CFPB has evolved over
Mm,
the 12 and a half years. And so I want to dig a little bit into this. So in the early years of the CFPB, they had this program called Project Catalyst, which was run out of the director's office, and it was essentially a way of sparking innovation within financial services. And they talked to so many companies, startups, established companies, etc., but nothing really happened. Like the purpose of it was to sort of develop policies or regulatory relief measures, and there was only
mm,
one that actually happened in like a 3 or 4 year period. So when Kathy Kraninger took the leadership of the CFPB, she was the person that President Trump appointed and was confirmed by the Senate. So she was the leader of the CFPB from 2018 through early 2021. It was a big priority of hers to like stand up an innovation office at the CFPB. And so they hired some people, they put some other people, moved some other people around. And what they did was they basically focused on giving um, regulatory relief through various things called like, no action letters or
mm,
trial disclosure waivers. So basically, like a sandbox approach, where if a company came in and had a new idea and it was not really clear what regulatory bucket it fell under, or maybe this is credit, or we're not sure if it's credit, or maybe it technically would violate something, but we think it's a really overall on net like a safe product, they would kind of pledge to not enforce the law against the company for a period of 2 or 3 years while they're experimenting with the model and things like that. And this was something that was successfully used, for example, in the UK. They
mm.
have a regulator called the Financial Conduct Authority that had a sandbox type approach. So for about 2 years, the CFPB was very actively, and I was part of this work because I was sort of a liaison from the regulations team to this innovation office. And a lot
Mm.
of a lot of the stuff that I worked on, like UDAP and RESPA, the Real Estate Settlement Procedures Act, we were starting to see companies with questions about, well, how do these laws overlay onto the products and platforms we're building? And so I would kind of become a consultant to the innovation people. So that was going really well for until 2021, 2022, and in my opinion, unfortunately, the CFPB has sort of moved away from that approach in terms of working with individual companies to help them experiment and give them regulatory relief. And now their approach to innovation, I think, is more about um, almost conservative in a lowercase c sense, where they're touting the fact that they have technologists who are now at the CFPB, but their sort of approach to technology and innovation is, in my view, a little more backwards looking. It's sort of saying like, okay, you're bringing this platform and product to us. That's awesome. Remember, you got to comply with all of the alphabet soup of consumer laws and regulations, even where there are those ambiguities, or even where, like in the case of RESPA, the law was written in 1974, and so now you're trying to figure out, well, how do I do kind of an online marketing co-marketing platform? Say, how do I make that compliant with a law that was passed in 1974 when the mortgage process was all done in person and on paper? So there,
Mm.
so I think in a sense they've taken a step backwards in their overall philosophical approach to innovation, and I'm hopeful that again, now that this like Supreme Court threat is sort of at bay. A lot of it, of course, will also depend on the next election. So if there's a change in administration, there's going to be a change in a lot of policies across the board, and it's possible that new leadership might kind of revert back to the Krager type approach of having that innovation office.
That's interesting. Yeah, I mean, I guess so. As much as people don't realize, and I'm learning it as well. Like we went to, we had a RegTech Expo that was on Capitol Hill, and it's really like a lot of these laws and regulations, unfortunately, or maybe fortunately, like are kind of political too. Like, hey, this is happening, but hey, this maybe it should lean this way or this way with, being stricter, more fines, maybe a new law focusing on this, and that's more political than people think. And I'm learning that as well, which is kind of fascinating.
Say that a couple other points. So one is that just for the audience to note. So one is that there's a lot of focus at the CFPB on consumer data in different contexts. So they have a major rulemaking that they started this year related to the Fair Credit Reporting Act, and they potentially, based on the pre-proposal that they put out, they're looking at kind of broadening the definition of what companies would be considered consumer reporting agencies. So, basically anybody that furnishes or that is sort of assembling or bulking together consumer data in some way and then selling it, is potentially going to be swept in as a CRA. And this would include data brokers and data aggregators. And there obviously are big markets for those things, particularly in an online environment. So that's one thing. And then, related to that, they put out and this might be of interest to this audience, they put out a report earlier this year that was really curious. It had to do with gaming and virtual worlds. And it was like a deep dive report where it went into a lot of detail about, the gaming market, the virtual worlds market, how consumer data is being used, how young consumers are essentially going on gaming platforms, and that's their first exposure to the financial system, because there's tokenization involved, and they're able to then sort of make trades offline that they start initiating online. And
that's super fascinating, because I'm like, it's just such a that's all the games. I grew up playing some video games, but really all the games have gone to this pay to play kind of like monetization strategy that is pretty dangerous, right? Or not dangerous, but like good.
But that was kind of the thrust of the report. And I'm Gen X, like stereotype, like my gaming was limited to like Super Mario Brothers and
classic
Mike Tyson's Punch Out. But this report is sort of an interesting illustration of what the Bureau is doing on technology issues, because I thought it was a very thorough and interesting report, and it raised some, I think, valid concerns, particularly about the targeting and marketing to young consumers. But the subtext of it was really like, we're going to maybe come after you, gaming companies and virtual world platforms, and sort of like casting this threat as you're sort of next, in terms of where we're going to aim our resources, rather than really presenting again like the type of dialogue or kind of approach that would be more akin to that type of regulatory relief situation.
Yeah, it's kind of funny, and this is just my perspective, right? The CFPB really, the focus was consumer financial protection. And when you think about that, you think of banks, lenders, even credit unions as well. But even, fintechs, obviously, but now it's almost like financial adjacent companies, right? Where there's some sort of financial transaction, even though it's video games. Now they're under the CFPB. The CFPB could actually enable fines for them. Is that correct? Like a nice hey guys, you guys really
the definition of what is considered a consumer financial product and service in the law, the Dodd-Frank Act, is pretty broad. So and it also covers service providers. It doesn't just cover the entity itself. And then just the last point on this is that they are doing what's called a larger participant rule, meaning they're designating certain sectors of the market for supervision and examination, and they're targeting big tech and fintech. So they have this sort of pending rule.
Watch out.
Well,
They're going after you.
well,
No, I'm just kidding.
I mean, it's so far it's digital, basically
Yeah.
digital payment applications.
Yep.
So, at a place like Apple, PayPal,
Yep.
Venmo, et cetera. But, the CFPB, sort of like once they get the hook into you for supervision, they can start looking at everything. And
Yeah,
so often
exactly.
they'll kind of take one issue and use that as their hook, and then they'll try to, kind of go through the audit of like the whole operation, and then
It's like,
other
how
issues
did you
could,
track this? Like, you guys, like, you obviously missed this. All right, let's look at more of your customer
right,
interactions, other
right.
customer responses. Like, how did you guys even address it? Oh, looks like you only had half of this and you just ignored this and you knew this was wrong, or at least it was negligence with it, right?
Yes.
Um,
Yeah, I
so
mean
it's,
that
yeah,
you're describing essentially like that's a core function of the CFPB and frankly any regulator of either state or federal regulator of financial institutions. They do a
mm,
periodic review of books and records and
yep,
policies and procedures every year or two.
yep, yep, yep. That's interesting. Well, unfortunately, we are at the end of time. Mike, this was amazing. I loved it. I loved hearing more about the CFPB. That was super fascinating. And we love closed loop systems. So hopefully, we won't get any CFPB fines for this. No, I'm talking about gift cards. So we don't do any KYC. And for all our guests, we do gift cards to random. You're actually in. Are you're in DC,
I'm in
right?
Washington D.C.
Yeah, yeah, that's right. That's right. I was just like trying to remember. It's like, well, we love giving away gift cards to random like Midwestern or chain restaurants. And today, on the random Midwestern or just like chain restaurant, we actually have Applebee's. So, hey, hey. I mean, everyone's got a little guilty pleasure for Applebee's, right? So,
I was gonna guess Macaroni Grill where you can like draw on the. Do they
oh,
still
you
have
know what?
Macaroni Grill these days?
Oh,
I
that
don't
was
even.
the other option. We can definitely, if you prefer macaroni, you do have a 12-year. This, I guess, a little too old.
I'll
Do you
take
have other
I'll
kids?
take I'll take I do have an 8-year-old girl also.
Yeah,
I'll take Applebee's.
Applebee's. I love their super cheap beer, by the way. It's like, I don't know if they still do it or not. I haven't been in a while, but they'll have like the tall boys for like $1 and $2. It's kind of nuts. But Mike, really great having you on. Super fascinating. Loved hearing the journey, and yeah, you hope you have a wonderful weekend.
I appreciate it, Jake, and I love what you and Gary are building. And yeah, I'm just
Wow.
glad we met like a month ago. So this is great. Thank you for having me on.
Yeah, awesome.